Please welcome to the stage, David Moffat, Managing Director, Inlandsis Fund.
All right. Well, welcome everybody. Thank you for joining us today here on the graveyard shift. We're almost there. Don't worry. Hopefully will be as entertaining a panel as possible on net zero and existential climate threats. But if you're in the back, we encourage you to come forward and join us up here. We promise we don't bite. So we're here to discuss the pitfalls and opportunities of net zero investment from the public and private financing sectors. No easy feat, and as I said, very much so an existential topic today, given the dire consequences of what will happen if we don't come up and meet the need. So we have some very esteemed and experienced panelists with us today that shall shed light on the subject. So perhaps we can start with a round of introductions.
Great, yeah, thank you. So David Moffat, my name was announced, a great fanfare. I'm not sure why no one else's was, but I helped run Inlandsis Fund. We created the first fund in 2017. Our anchor investor is Quebec Pension Fund. We have supported over 40 carbon projects in North America so far. And both compliance and voluntary markets and a wide variety of project types, as well as some clean fuel projects. So yeah, pleased to be here, even if it is the graveyard shift.
And I'm Luke Oliver. I run the carbon and climate aligned strategies at KraneShares. We're an ETF asset manager, and we manage about 11 billion and about 300-400 million in carbon strategies. That's almost exclusively in the compliance space, although we have dabbled in the voluntary space, or as I tend to call them, project-based carbon.
Perfect. And just to round things off, I'm Zara Osnadane. I work with Katona Climate, where we finance, manage, and monitor carbon sequestration projects, primarily in the nature-based space. Prior to that, I was in the finance sector for about 13 years and primarily in the investment banking and development finance areas where I had the opportunity to work with the public sector and also on blended finance transactions. So with that, we should jump right in. And it's clear that the task at hand is formidable, to say the least, in terms of meeting that gap required to meet those targets, net zero targets by 2050. There are so many numbers that are thrown out that are truly hard to comprehend. And for example, the Climate Policy Institute estimates that we need an average investment, annual investment to reach 9 trillion by 2030. A similar study by McKinsey says that we need a cumulative investment in climate finance of around 275 trillion. And these numbers are really quite staggering. So David and Luke, you sat here, I think, 3 years ago, potentially, on a very similar panel. So my question to you is, are we headed in the right direction? What has changed since you were last here?
Well, a lot's changed. You know, we've obviously seen sort of boom and bust again, you know, through the voluntary markets. And on the compliance side, we've had a terrible couple of years. A lot of that was off the back of the Ukraine invasion, a lot of volatility in natural gas prices, threats to economic output from Europe, which leads to lower emissions, which is a good thing, but not because you've solved any problems, you've just got less production. And so that's all led to softer carbon prices. So we've seen, between performance and flows, it's been very negative. And but that said, I think the big changes are that I think the carbon markets, the compliance markets, are very well positioned from here. You've got sort of the end of the policy making that softened prices in Europe, which was this Repower EU, where they front loaded the auctions for 3 years. We're in the last year of that. And so we've got a bit of a cliff in terms of the tightening. So that should be positive. We've also got, California, which, everyone's super focused on. Maybe have a similar scenario where, we suddenly have some breakthroughs there and clarity on policy, and we'll really see liftoff. And then I think that the biggest thing is, and this whole conference is about this stuff, but I think the V in VCM needs to go, and we just need to talk about these projects and which compliance programs they feed into. And so having the Article 6 has been a big deal. Having Corsia, I know there's all of these things. The big continuing problem is nothing is solid. Everything's sort of shaky, and it's hard to plan around it. But I think we're sort of getting in the right direction. Absolutely,
and I think that's such an important point around the V and the VCM. Like, really, the V needs to go, and it just needs to be what we're hopefully seeing is a convergence towards the compliance markets globally. But David, what have your perspectives been since over the last 3 years?
Yeah, I mean, I could certainly start with just the last 3 months and just how much things have changed in this country. And just with, the ending of, 32 EPA regulations. Apparently you can now, instead of actually addressing clean air regulations, you can just send in a template email and say, we don't have to address it. So I think that just underscores just the amount of volatility and challenge, frankly, in this country versus the rest of the world. In terms of changes over the past 3 years, I think it'd be great to move from drop the V. I think we're a long way from dropping the V in most cases, and I think we can get into that a little bit more. Huge changes in addition to the ones that Luke had mentioned, just the media impact on offsets and the credibility perceptions related to that. Huge switch to removals led primarily by Microsoft. Microsoft being by far the biggest buyer, certainly in CDRs and probably on nature-based as well, and that's just non-tenable in a longer-term perspective. And then on a more positive note, like early kind of institutionalization, I'd call it, in this market, where you have some of the banks that were in previously when CDM was around, like BNP Paribas is back, Barclays, JP Morgan, global asset managers, global insurance companies like AXA. So I think that signals that it's moving away from what it has been, which is a lot of smaller niche investors like Inlandsis, and scaling up. And we expect to be part of that scaling up, but I think it's a good thing that we're having global players coming into this market. And that needs to happen quickly and at a scale to come anywhere close to addressing what you talked about at the beginning, Zara, in terms of just the climate change urgency.
Yeah. And it's so interesting that you mentioned all these large private sector companies, because clearly over the last few years, it's evident that the public sector alone cannot at all meet the challenges that are at hand, and you really need that mobilization of private capital and private companies to come in and take the initiatives there. But you do need that public almost guidance and enabling mechanisms for those funds to flow. And so really, if we delve further into the private sector, I mean, clearly we've seen a real popularity around some green instruments that have existed. So green bonds, for example, that were very, very high volumes, over-subscription rates. We've also seen, of course, a lot of funds flow through private placements and certain climate tech companies, municipal bonds, and then obviously more tradable tax credits come into play. So just curious to see what your views are on instruments like that, how you play with them in your businesses, and how you see the trajectory going forward.
Yeah, so for me, everything always, I'm just such a strong believer in the compliance carbon market. So that's that public framework, but it doesn't take a lot of public spending. It just takes public policy in creating the framework. And so I think that tops everything, because there's this great stat with Richard Sandor when he did the cap and trade program for acid rain. And I think the research that he did showed that for every dollar that was actually spent on the credits, there was $3 spent in solving the problems. So that price signal created this kind of 3 times multiple. And that was a tiny problem relative to what the carbon markets are addressing. And so I just think that everything that not enough money could ever be spent creating incentives for people to go greener or decarbonize. There's not enough money in the world. Even the numbers you're talking about are staggering enough. But so to create that price signal, you make it economical, and suddenly it's not about, that's again, no V's here, right? There's no one doing anything because it's nice. They're doing it because it's economical to do it. And so I think all roads kind of lead back to have a robust carbon price, and then everything falls into place. People start to do the right behavior. Things like green bonds have struggled because you tend to have to give up some yield to buy the green bond, which puts it back in this camp of, I'm voluntarily taking an economic hit to do something good. How about just make it that those companies really want to spend money on decarbonizing, and it's just a normal bond, but they're spending it on decarbonization. So I just think some of those labels and putting stamps on things isn't real economics, and it's not real finance. I know that sounds a little harsh, but create the economic signal, and then the big guys, if you like, will do the right thing. Yeah, it makes sense.
Absolutely. And I mean, I think we'll come back to the question of carbon price later, because that is such a crucial tool in terms of creating this market and really creating the mechanisms for the funds to flow in the correct places. But David, did you have anything to add to that, or?
Yeah, I guess just on that point, I think we can idealize cap and trade, and Lord knows for our fund, that's how we did for the first 4 years, and we would love to do more and to see it be bigger. But the reality in at least North America is, Quebec, California linkage has been in place for a decade. Washington may join. The Biden administration very carefully decided to do the IRA instead. There was no way they were going to pass cap and trade in the US Congress. That was tried Waxman-Markey. It failed in the Senate. So, and sure, economists love cap and trade. We love cap and trade, but I think there's a lot that has to be done outside of what would be the ideal. And that's where we've ended up playing, where we're putting more capital now into the VCM, partially because in California and Quebec, we don't know what happens after 2030, and we make investments for 3 to 10 years or longer, and that just, unfortunately, doesn't fit with us. So, right. Yeah, I mean, Canada just pulled its consumer carbon tax. So a lot of reasons why it would be great, but it's been hard.
Right. And I guess in order to get that private sector to play within the VCM, you obviously need to have all the real conviction at a corporate level that this is a market that they believe in the long term, but also is one that is right in some way. But I think that over the last couple of years, we've seen a little bit that fervor dissipate since 2019, 2020, where we had a whole slew of net zero commitments come in at the enterprise level. And now I think, at least over the last couple of years, we've seen some companies back down a little bit on those commitments. And we've also seen big financing banks really move away from net zero, the Net Zero Banking Alliance, for example. So do you see these moves as really damaging to us reaching our goals for that 2050 mark? And do you think that there will be material changes in the way these companies operate based on these step backs?
Right. Interesting question. I mean, there's certainly a lot of green hushing happening now. Like we've met with, senior executives at, some of the largest Canadian banks, and they've said, yeah, we're still doing the same thing. We're just not going to be as public about it. How that filters down to investment decisions, how it plays out with what happens with the Trump administration going forward. I think it's, there's huge questions around that. But there's no question in our mind that if you do not have strong demand for environmental credits, carbon credits, that they will not grow out of their essentially pathetically small size of VCM right now. And that seems to be and has to be a very valuable tool for addressing climate change. So it's, I think Luke kind of painted it pessimistically at the beginning, and I think appropriately so. But yeah, a lot has to change, and there needs to be corporate leadership. And frankly, that's pretty hard to do in this country, in this environment right now. So,
anything to add to that, Luke?
Yeah, well, just to echo that, really, that it is challenging. Like there's no doubt that it's a backwards step. The only sort of maybe the lesson learned, but it's a tough lesson because we all know the clock is ticking. But I think it's been lumped into a lot of things that are now politically dangerous or offensive or polarizing at least, and it shouldn't be one of those things. But I think maybe there's a lesson there in how it was done and the messaging around it, and maybe it should always have been more subtle. Maybe it's certainly. Didn't feel like anyone was doing it the wrong way, but I think the reaction to it tells us that this is we have to go at this again in a different way that is more palatable.
Well, I mean, even I think across the Atlantic, you're seeing European companies, large oil and gas organizations that had laid out some very ambitious net zero targets, walk back on them because their shareholders are comparing them to their US counterparts, and the shareholder returns are not up to par. So I guess my question is the system rigged? And I guess this is more of a philosophical question, but we're really, currently the market is structured to reward short-termism and total shareholder returns, which is the only real thing that people seem to care about in a lot of big corporates, and especially on the lending side. So how does one counter for these kind of very skewed incentives in the economic system?
Yeah. See, so I don't know the answer.
Sorry, very very deep question.
It's mind-boggling that something. Look, I feel like if in the 80s we would have all jumped on that. This is like, I was raised on all these cartoons, the blue guy who saved the planet every week, and I don't know why it's so rigged. One thing I think about is the fact that do we solve this? It's very optimistic, but do things like AI and massive ramp up in the need for energy create more demand and more risk of energy security, and actually just good old demand supply requires that we have to get more efficient with energy, and maybe it accelerates nuclear, accelerates some of the less carbon intensive solutions, and it just starts fixing itself in that sense. But that's not a plan. That's hope. That's crossing your fingers. But the kind of cat is out of the bag a little bit in that some renewable pricing's come down. It's got more competitive. It's scaled. It may compete in its own right and get there.
Well, I think that's a really interesting segue because I think there is a small but growing class of investors that is really looking at innovation and climate tech as a area that they want to invest in and a growth opportunity. So they've coupled growth with sustainable development. And I guess potentially to our audience today, would you have any advice in terms of how to access those pools of capital? If you're a project developer, what commercial hurdles and key project characteristics would you be looking for if you were to try and access those pools of capital?
Right, I guess we'd be one of those pools of capital. And I think the premise that you kind of outlined of sustainable development with kind of market returns, that's at the foundation of what we do. It's also something that we're testing out. Like, does it work? And in some areas, like to get very kind of specific, afforestation is really challenging with growth rates of trees. Certainly in North America, it's better in the global South. So there are a host of things that I think if you are expecting market rate returns, becomes very challenging to do. In terms of advice to developers, I think at the fundamental level, it really is just building trust with the investors and understanding what their objectives are, what their parameters are. And part of it is just a timing thing where, is capital available? Are you already overinvested in a certain type of investment? Or is the market souring on it? And, for us, it's that clarity of demand is essential, and cap and trade, we need to see an extension. For VCM, if it's new project types, we want to have real clarity around that the buyers will be there and at a reasonable price, and that it's not just a fashion trend that's going to die in a year or two, because our investments last a lot longer than that.
Yeah, and I think that's such an interesting point you make around the duration and the rates, because I think we'll come back to this subject a little later if we have time, but I think a lot of the ways in which public finance can really catalyze that private inflow of capital is by blending in rates at lower cost of capital and also longer duration, so that it is more affordable and more attractive for those private capital investors to come in. But I guess staying in the theme of what people are looking for and transparencies, of course, disclosures and taxonomies play an integral role in terms of providing investors with the information that they're looking for and stimulating, or at least facilitating those capital flows. So is there enough transparency in terms of what the public side has instituted or implemented in terms of the areas that you're working in currently? Because Luke, of course, in terms of creating new funds and SFDR, I'm sure has an impact on what your day-to-day potentially.
Yeah, well, so it interestingly doesn't actually. Like, it doesn't have a lot, doesn't affect us a lot, because that tends to be around sort of I always think of being in the compliance carbon markets as being, it's not ESG, but it's the biggest capital E and the biggest capital G you could possibly have. But none of the data providers or the MSCIs and the S&P, you can't categorize it as ESG because it doesn't. Those metrics are for looking at company boards and company activity. There's no company, there's no activity. It's just a price mechanism. And so I know I keep coming back to that, but that price mechanism is the best thing that an investor can do, more so than saying, I'm not going to buy oil companies, or I'm going to use SFDR and ESG metrics to change the portfolio. Well, how about just invest in the price of carbon? Because the investment thesis we can talk about demand and supply and policy and all of these things, but the basic mechanism is that as a financial investor, you get paid. You get paid when you lend some, you buy a bond, you invest in the company, you have a share of the company. With carbon and with a lot of commodities, it's your job as a financial player to say, this is an undervalued asset, it's at X, it should be at 2X, and my job is to buy it, and I earn that premium as it grows to 2X, and I then sell it to the compliance companies when they need it in the future at that prevailing price in the future. So you deserve to earn that premium, but you take the risk, and the risk transfers to the investor. But that's the job of financials, and I just think that's very powerful. That's what you can spend your dollar on, doing that service, and you get the appreciation, which is significant return. We think that between the majors, between now and 2030 is going to look like an annualized sort of 20% a year. Of course, you can also have a 40% down year, but when we get to the 2030s and you look back, we think you'll be able to see a 20% annualized return. So that's the ultimate catalyst. And I just mentioned that because a lot of people think of it as like this, you're buying this thing that should go up, but it's our jobs to buy it, to go up. That's what financial players in all commodity markets, that's their purpose. And and likewise, if the price gets too rich, it's our job to sell it and take profit, and also therefore bring that price down. So it's a great mechanism, but it still relies on government conviction to support the program, and that's dicey.
Yeah, absolutely. And I mean, I guess now with the current administration, at least in the US, and you're seeing this kind of step back in terms of climate leadership, at least coming out of...
Step back? You are well behaved on this panel. Wow.
Well, I was just going to say, who is going to fill that? And is China, for example, coming in as a regional player that is going to take some leadership? Of course, they are doing a lot, but it's still, I guess, subject to a lot of scrutiny.
It's a real misconception that China is a villain in the carbon pollution field, because first of all, they pollute per capita. It's not that high, but their gross pollution is high because every other country sent all their heavy industrial production there and exported. It's our pollution that's just happening over there for all these things that we want to have. So there's that. Secondly, they are taking a lot of action, but their carbon policy is more about reducing carbon intensity. So they are acknowledging that they can't start cutting in the same way that Europe has, but they're going to peak at 2030 and then start to come down by 2050. But they also need power. Like, they're still building coal power plants, but they're also building more renewable than others. But what's interesting is so they do have a carbon program as well. It's adjacent to cap and trade. But what's interesting is that Europe's CBAM, which is the carbon border adjustment. So for those not familiar, you have a price of carbon in Europe, and they used to give certain industries a discount because they were not competitive. So I always use the example of German steel and Indian steel. If you put a carbon price on German steel, then German companies will pollute less, but they'll also start to lose out to Indian steel. And so we'll buy Indian steel instead because it's cheaper, and the pollution will happen in India rather than Germany, and you didn't solve anything. So they were giving discounts to the German companies. The new program starting next year is that Germany doesn't get, the German steel doesn't get a discount, but you get a tariff on the Indian steel equal to the carbon price. Mm-hmm. So what's interesting in kind of the natural, it's interesting, the deal also says that if they have their own carbon price, it gets discounted from the tariff. So now we've got Turkey and India, two of the biggest exporters into Europe, have now announced plans for cap and trade program. So that's all very new, but it's working. So this idea that you're exporting this price of carbon and encouraging these other places to I always use the example of when Europe banned lead in microchips, it banned it globally because all the chip producers didn't want to have two production lines, so they just figured out that we'll remove the lead and everyone gets lead free. So it's quite, so Europe does that. Now, we are, though, in unprecedented times in that these US tariffs on Europe, is that going to reduce economic activity in Europe? Is that going to lead to lower carbon prices? And if you keep, the same as we see in VCM, if we keep we keep pulling the rug from under these things, people lose faith in it, and you don't get capital flows when you don't have faith.
Right. Well, and I think Europe is, sorry, did you want to add anything?
No, yeah, we don't work in China.
Yeah, but I mean, I guess, you know, it is interesting to see how Europe has led the way in a lot of the climate initiatives, at least on the policy side. And you have the Green Deal and obviously CBAM. How do you see, I mean, obviously, I think what China is doing is a little bit along those lines. And you see a confluence of mechanisms like that come into play and hopefully peter out through the global economic system. But how do you think CBAM is really going to impact some of these other mechanisms that are coming in regionally?
So the idea is that CBAM will encourage countries to have their own price of carbon. And I was talking to someone yesterday, and they said that the price has to be similar to Europe's price. And I don't think it does. Like, for example, if the price of carbon in Europe is 70 euros, or we'll just use dollars as one, you know, for simplicity, $70, but the Indian price is $15, well, that might be the right price, because that means the Indian company, for what they sell into Europe, they're going to pay 70. They're going to pay 15 here and 55 there. And for everywhere else and internally, it's only 15, and that might be a more palatable number internally. So it doesn't have to be the same. These markets, you know, California's at 30, Europe's at 70. They don't have to be the same to work. They probably all do start to converge to some, you know, 150 or so, like by 2030. But yeah, I think that's the point. I think it's having so far the intended consequences, which is a great thing. Pre-Ukraine invasion, this was on a really good track. Of course, you know, these things happen, and it's very disruptive. But I think the new sort of cloud on the horizon, and I don't know the answer, is what is the US's response to CBAM going to be? I don't know.
Yeah. I mean, who knows? But it certainly won't be popular here. So,
Absolutely.
Very challenging.
Yeah. Well, delving further, I think, back into policy, I mean, blended finance, concessional loans, subsidies, they all have played a pretty critical role in terms of dispensing those public funds and also catalyzing that private capital. And at least in my own experience in working in projects that were nature-based, where you do need longer-term capital commitments at cheaper costs, they played a pretty catalytic role in terms of allowing us to bundle rates with private investors so that we could help those private investors reach their desired cost hurdle rates in terms of IRRs, and also allow those projects to take off. So I guess, David, have you interacted with any of those kind of public funds? Have you used any of those as you invest and deploy your own capital?
Yeah, we have, I mean, just an example, we have at least 2 grassland projects that have benefited from USDA funding of easements that was beside ours, and, you know, allowed those ranchers, and really those ranch families, because they've been on the land, in one case, like 4 generations of ranching, to stay on it and to commit in the long term that those lands will remain as grassland. So super valuable. We have a peatland project where the natural owner of that property ultimately would be a federal conservation organization based on proximity and the value of that property to them. So the ultimate kind of takeout of the investors is likely to be that. We don't know when it's going to happen, but previous to setting up Inlandsis, I did a number of conservation finance transactions where, you know, you were providing essentially mezzanine capital, or in some cases longer-term capital, for ultimately a government takeout, and that's hugely valuable. Where it's needed right now, in particular, relates to wildfires, reducing the risk of the fires happening, and then restoration of those areas. And we haven't been able to make those projects pencil out. We would love to get involved in them. So I think great example of where blended finance, at least from our perspective, is really desperately needed.
Amazing. And I mean, I guess another instrument that has been used in the past to help prop up certain industries has been subsidies, and famously oil and gas subsidies are still in existence and still being funded today, which is really quite astonishing, to put it mildly. Do you see similar instruments being used anywhere in either of your experiences around carbon projects in particular?
I've not been close to that side of things.
Yeah, I mean, the tax credits hugely helpful through the IRA. So for smaller scale projects that we like to get involved in, like biochar, larger projects, BECCS, DACs, I mean, they all benefit or have the potential to benefit from the tax credits. What happens with those going forward? I mean, there was a great creation of effectively subsidies through tax credits that have just blossomed that space, and now there's just huge uncertainty around it within the US. And other governments like the Canada Growth Fund, the Canadian Infrastructure Bank, and obviously Canadians advice there, is doing much of the same thing, and we're seeing that with EV project types and other project types that we're looking at, where you can stack some of that government, either grants or cheaper concessional capital to really make things happen that, frankly, we couldn't do on our own in terms of size and in terms of our risk and return requirements. So they've been great. So.
Well, I mean, I think it seems like there's definite consensus on this panel that we need those public funds to come in, and that convergence between compliance and the voluntary sectors, and also that crucial setting of the carbon price from a government level, at a government level. But I think as we begin to conclude the discussion, dusting off your crystal balls, what can you see happening in the next year or two? Where should investors be putting their capital, and what should us as participants be betting our careers on?
Oh my goodness.
Right. I mean, maybe to start with a pessimistic note, I have friends who work in biodiversity, and they can't use the word diversity when it comes to US government documents they're helping putting together, so that makes it difficult. So, is there a North American carbon world next year, or it's just North American, I don't know, something else? So, yeah, I mean, that part of it is just bizarre. We wonder about, will there be export capital controls so we can't get our capital out of the United States? So there's a lot of bigger issues that are at play, unfortunately, at this point.
Mm-hmm. Luke.
So I'll take the less pessimistic one on this turn, but which is that something in the asset management space in general is, and I know at least two companies using this internally as a phrase, is make diversification great again, which is that you need alternative investments.
Yeah.
And so everyone is looking for alternatives. And I pitch that compliance carbon, that's all I talk about, but I pitch that that's the ultimate diversification. It's got the same Sharpe ratio as US large cap equities, which is about as good as it gets. And but it's roughly double the return over time and double the volatility. And I don't think the volatility goes away. So it's a higher risk and return. So Sharpe is about the same. But the correlation to US equities is 0.3, which if you're not portfolio managers, that's incredibly low. Meaning that in a portfolio, it's going up just like US equities with the same risk and return, the same sort of risk return metric, but at different times. And so as a portfolio tool, it's incredible. So I always, say to people, if you had a blindfold on and I describe this thing that was 0.3 correlation, but a 0.8 Sharpe, they would say, of course, that's the best. What is it? And surprise, surprise, it's carbon. So people are looking for, and if you think about who has been investing in these things, it's large single family offices, it's endowments. Those are the so-called smart money. This is trickling down, and with our products, we offer them. Anybody can buy these. Any financial advisor, any member of the public can buy them. So people are looking for stuff like this. They might, to your point, I make sure we don't say ESG, or like my title is head of climate investments, and I chose that because I didn't want it to sound too woke. But now climate is a word that people say, oh, this is a woke thing. And I'm like, I've got to explain. So I always start now with the slide with the risk return and correlations. And I'm like, this is a grown-up hardcore financial product first. So there's that. And then also, I'm kind of curious about Scott Bessent at the Treasury, because in his two things he said that are interesting to me. You know, he talked about carbon pricing as something, or carbon tariffs could be on the table. That's interesting, right? That means that we're not a million miles from that being something that could be used. I don't know if it will be used in the right way or with the right motives, but if you put a price, like I would love to get in and talk to those guys, because if you wanted to really bring jobs and industry back to America, why did it go away? Because it's cheaper to make it somewhere else and ship it back here. Put a tariff on all the carbon that those ships are putting into the atmosphere, and then suddenly it's not cheaper anymore to buy those imports, and we'll start making it here. So they could really use carbon pricing as this incredible weapon, and nobody would say, oh, these villains putting tariffs on us. They'd say, well, I guess they're doing what we wanted them to do. They're trying to save the planet. So a little bit cynical, but who cares if it's cynical or not, if it's solving the problem. And then I also, he was on a podcast I listened to yesterday, and he was talking about energy transition and lower carbon transition. And he was talking about it very sort of fluently and naturally, as if, you know, this is something that's coming. So I think that's somewhat promising.
Yeah, and maybe to also build on the more promising side of things, you know, California will be providing clarity this year on its extension. That'll unleash some capital. Washington hopefully will join over the next year or two. So then you've got 3 jurisdictions in it. I think WCI or ICVCM, is bringing in a level of trust from buyers now that will start to make a difference. And I do agree with Luke on Article 6 and Corsia and the opportunity there. Yeah, I have to say, from our team's perspective, because we go to a lot of IETA, so International Emissions Trading Association meetings, and for years they talked about Article 6, and we would all just pull out our phones like, this is just going to take forever. And that has changed now, and it is actually, there is an interesting arbitrage potential of moving to compliance or semi-compliance from voluntary projects. So we're a lot more attuned to that than
we had like Suriname issue their first credits under the ITMOs. So yeah, hopefully we'll see an acceleration of activity coming from Article 6. I was just going to say that at least offers a glimmer of hope in terms of that convergence of those the two markets that
and CBAM could too. I mean, that would be incredibly powerful if that built out. There's just a lot of uncertainty around, obviously, trade at this point. So.
Well, thank you. So I guess we can open it up to the audience for questions if there are any. I think we have one here.
Should the US dollar be the reference currency for all this stuff?
Really interesting.
Wow, I dropped out of macroeconomics. I'm not going to push that question.
I don't see why not, is the short answer. But I mean, this is a whole other conversation, I guess. But this is something I struggle with all the time, which is, we know it's overvalued. We know that this is where I swore I'd never invest in gold, because it makes no sense, because you can't eat it. It doesn't get used for anything other than jewelry and things like that. And so and people, this is way off topic, but I'll tell it anyway. But I used to run a gold fund, and we used gold futures, and people used to not buy it because they said, we don't want your futures. We want to buy the fund that has gold in the vault. And I said, why? And they said, because if there's like a nuclear war or a famine, I can go and get it. And I said, you're going to go to the vault in London and somehow in this post-apocalyptic world, and get there and persuade them to cut you a slice of the gold bar, and then what? And they're like, well, I want to know that it's backed by physical. Anyway, so that never made any sense. But I found myself a few years ago starting to buy gold and Bitcoin, which is that's another whole topic. But the point is, you need something that isn't the US dollar, and usually that would mean euros or yen. But why do you want those? And so I'm finding myself looking at gold, and I'm looking at, I think you need an allocation to gold and to Bitcoin. But back to whether you should price things in dollars, for now, I think it's appropriate.
Oh, we have one here.
What's your investment thesis or recommendation for project development? What are the other for like the next 3 years in kind of the times that we're finding ourselves in? Is there an investable notion to go behind and support at this point, or is it a wait and see
Right.
where you want it to go and where you see?
I think it, for us, depends on the developer too and what their skill sets are. Like, we have seen developers, and one in fact at this conference, where started in methane, went to forestry, and is now thinking CDR is the place. And yet it's not as though the team has built out necessarily the skills to do that. So I think you have to play to your strengths or the strengths you can build. But I think there are promising spaces, and I think where you're seeing on the voluntary side, the major buyers putting their capital, and they're also pretty transparent about framing up what they want to see for quality. And I think trying to address those is a good and frankly safe path to take. The consortiums are exciting related to that: Symbiosis, Leaf, Frontier, Beyond, because then it's a number of companies, and you're not relying on one gorilla kind of signing the contract with you. So I think those spaces are really good. I think Corsia and Article 6, which we have less direct experience in at this point, is also really interesting. The cap and trade markets, I mean, California is oversupplied on the offset side, and there's the overhang of what happens 2030 that should be addressed. But some of the smaller markets, Alberta, also oversupplied, but very interesting. British Columbia has a new market as well. So, I heard Luke very clearly at the beginning, appropriately saying, putting a price on and the markets help. So there are some smaller markets that we feel are attractive, and you probably also want to always think about, if that market blows up during your crediting period, and the crediting period can be 40 years, what's your backstop in terms of what the sales could be associated with those credits? So yeah, I don't have, it's not the boom town it was a number of years ago, where, a colleague of mine said that that IFM credits would sell themselves. Clearly that hasn't been the case for a number of years. And I think he regrets saying that. We certainly chuckle about it. But there are opportunities out there, and there certainly are investors like us that are committed to these markets and have been through lows before, and others that have been through more severe times and done very well, both for the developers, for the investors, and frankly for the environment. And there's just so much innovation that goes with the V in VCM that we don't see in cap and trade. So we're always thrilled to see new project types, new methodologies, and have the chance to look at them.
Yeah, and I think I'd add to that, staying close to what the corporates are looking for is especially important. And you have seen over the last few years these large names emerge that have the conviction, that have set out plans to buy credits regardless of what the political climate has been. So lumpy as it may be, those transactions are still going to come in. Obviously, it's not the same as a real market in that sense. It's over the counter, but those organizations that have set out these pretty ambitious goals and have continued to buy over the kind of very challenging times the market has faced will continue to do so.
I mean, and just to clarify, when I talk about getting rid of the V, I don't mean getting rid of the projects that are generating credits. I just mean we need it to not be voluntary in order. Well, I mean, those people bearing the cost. I think sort of conventional wisdom is it's sort of global south, but generally it's the public, wherever it is. And I think that's them being invested in it is electing people that will do something about it. And yet somehow they've managed to get people to vote against doing that. And it's become one of these polarizing things. And that's kind of what I was talking about at the beginning is, and it could be, as I think what you're referring to is like people lobbying to not have to internalize. We need to sort of fight back against that. And that's the big conundrum. What will happen is eventually it will be so undeniable that there's a problem that it will become the obvious thing to run as a politician on. I'm going to help fix this problem, but we're not there yet. And the problem is we shouldn't have to get to that stage to do something about it. But yeah, I don't have the answers for how we rally grassroots movement to get people to do that.
Right. No other questions? Oh.
Good.
Oh, here we have another one.
I'm working on it. I was talking to a friend of. Actually, maybe I'll be careful. But I've been trying to figure out how to get into some of those circles and have that conversation. So I think it's brilliant. I think they could do it, and they could even be kind of a wink, like we don't really care about this stuff, but it's going to work, and it's going to get jobs back here, and it is going to work in reducing emissions. And so, working on it. I'd I'd love to see it happen. Yeah. Yeah.
And they do want energy security, and they want manufacturing, and they want jobs here. But we do have a Secretary of Energy who, is called Wind Farm Sinister when he was visiting the UK, and the presidents could not be less enthusiastic about them. So, yeah, maybe it's there, but I sure as hell can't see it.
There is this fundamental suspicion of sustainable energy sources as not being, as taking away jobs rather than creating them, which is completely inaccurate.
They're almost not manly enough for them.
Yes.
Like, you have to be like digging the stuff out of the earth with a pick.
Yeah, covered in coal.
Yeah. But anyway, we are digressing from I think the main
But I will say, if anyone wants to help with that, let me know. And it's not my
Happy
job.
to brainstorm.
But it's something I want to do as well.
Perfect. Any other questions out there? All right. Well, thank you very much for joining us, and thank you to our panelists for a really interesting discussion.
Thank you.
Thank you.
Yeah,
Thanks.
Great. Good.